This is a preview video. Thanks for joining us at XM.com. As investors price in aggressive rate cuts by the Fed, upcoming data might be crucial in solidifying those expectations. I'm Cristina Marujas. With me today is our senior investment analyst, Marios Hadjikyriacos. Marios, following a strong inflation report last week, this week's retail sales data is expected to reveal that the U.S. consumer continued to spend in December. How could this report shape markets' expectations regarding Fed rate cuts?
Hello, Christina. So, look, the last few months, the market has been trading on this theme that the Fed is going to cut interest rates, they're going to cut them aggressively. So what we've seen in recent weeks is the market pricing in heavier and heavier rate cuts by the Fed for this year. Now, what I find strange, Christina, is that we've gotten some encouraging data points out of the US lately. We had a pretty decent employment report, then we got a hotter than expected inflation report, both normally data points that would dampen some speculation around Fed's rate cuts, and yet that didn't happen. The market is still pricing in a very fast pace of rate reductions by the Fed. So it almost seems that investors are laser focused on interest rates coming down. They're almost ignoring data points that suggest otherwise. Now, the curious part, the interesting part, is that that might change if we get a third data point in retail sales pointing to the strength of the US economy. So let's talk some numbers, Christina. In December, retail sales are expected to have risen by 0.3%. That would suggest that it was another successful holiday season, and that's we've seen some other data that suggests that. For example, we got some monthly credit card spending data from MasterCard. We also had CNBC retail sales monitor. Both of those pointed to another solid retail sales print in December, and in fact, both of those pointed to some upside risks for that print. So if anything, if there are any surprises in this data set, I think it's more likely that we'll see an upside surprise in retail sales. And if that is the case, then we could finally start to see the market pricing out perhaps some rate cut bets by the Fed.
And now let's turn to the market reaction. Marios, how could the dollar move on the retail sales data?
Yeah, so if indeed we see an upside surprise in US retail sales, that would likely benefit the dollar whenever the market starts to reduce its bets for rate cuts. Usually that benefits the currency. Now, in the broader picture, Christina, we've seen the dollar struggle in recent months. As I mentioned, the market was playing around with this idea about heavy rate cuts by the Fed. Now, another reason behind the dollar's underperformance, I think, was the massive rally that we've seen in the stock market. So the dollar, of course, is considered a safe haven asset. As the stock market goes up, usually you see demand for safe havens decline. Now, the question, Christina, is will this trend continue or reverse moving forward? And I suspect that there is some scope for the dollar to stage a comeback in the coming months. The US economy is still in pretty good shape. That makes the market pricing for the Fed to cut interest rates more than 6 times this year. It makes it appear a little excessive. So if we continue getting data points that suggest the US economy is resilient, we could see traders unwinding some of those rate cut bets, and the dollar could stand to benefit. Now, similarly, the outlook for the euro area economy is quite dark, and that makes it difficult for the euro to sustain any advances. So all things considered, I think that the upside risks surrounding the dollar outweigh the downside risks. However, how the evolution of global risk sentiment in stock markets and geopolitical events, those will also be crucial for the dollar's path.
Marios, thanks so much. This was a preview video here at XM.com.